Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Glad to be here for another deep dive.
Yeah, it's great to have you. I'm your host, and today is Wednesday, February 25th, 2026, and I want to kick things off by talking about optical illusions.
Oh, I love those.
Right, you know the ones where if you look at it one way, it's a duck, but if you just tilt your head slightly to the left, it's a rabbit.
I know exactly the ones you mean.
Yeah.
And usually in the financial world, if you look at the data long enough, you realize the duck everyone is hyping up is actually a bear that's about to wake up.
Exactly. And that is really the theme of today's deep dive. We have two massive stories that prove things are absolutely not what they seem on the surface.
So, I mean, it's a classic case of looking under the hood.
It is. So first, we are looking at the cryptocurrency market. If you just glance at the headlines or your trading app, it looks like standard volatility. Up, down, But if you look at the structural data, which we are witnessing a massive divorce.
A total split.
A tale of two cities. One side is booming like it's the early internet days, and the other side is, well, let's just say it's sweating through its shirt.
That's right. It is the definitive split between digital cash and digital gold.
Yeah.
And honestly, if you don't understand that distinction, like if you're treating all crypto as one giant asset class, you are basically trading blind in this market.
And we definitely want to help you avoid that. So that's topic one. And then for our second act, we have to talk about Washington.
We do.
President Trump just gave his State of the Union address last night, February 24th. And he talked about everything, the economy, tariffs, bringing manufacturing jobs back. But there was one word, one very big, usually very loud word, that was completely missing from his economic vocabulary.
The silence was deafening. He didn't mention China in an economic context. Not once.
Not a single time.
And considering this is Trump we were talking about, that isn't an oversight. That is a specific calculated tactic.
It's suspicious is what it is. It's like going to a Metallica concert and then playing acoustic folk songs all night. You just know something is up.
That's a great way to put it.
So our mission today is to unpack these two mysteries for you. We're going to look at the hard data, specifically some recent earnings reports and some dense Supreme Court rulings to figure out what is actually happening.
So that you can sound like the smartest person in the room at your next meeting.
Exactly. Let's start with the crypto split.
Let's do it.
Okay, so usually when I'm at a barbecue and someone asks me how crypto is doing, they are really just asking what the price of Bitcoin is today.
Right. That's the default metric for the average person.
But according to the stack of research we have here, the real story for the first quarter of 2026 isn't Bitcoin at all.
No, it's not.
It's a company called Circle and their coin, USDC.
Absolutely. If you are only watching Bitcoin prices, you are missing the massive structural shift happening underneath the floorboards. Circle, which is the company behind USDC, they just released their Q4 2025 earnings.
And USDC is a stablecoin, right? Just to clarify for everyone. Yeah.
Exactly. It's a stablecoin pegged strictly to the US dollar. And the numbers from their earnings report are frankly staggering. Their revenue hit $770 million.
Wow.
Yeah, that is up 77% from last year.
77% growth is massive for any company. But I want to push back on this a little bit because I know what people are thinking.
Sure.
Is this just another crypto bubble? Like, is this revenue coming from people gambling on the coin, hoping it goes to the moon?
That's the key difference, and it's why this matters so much. You don't gamble on USDC. It's a stablecoin. It is always worth exactly $1.
Because you don't buy a dollar bill hoping it turns into $2 by Tuesday.
Right. That would be a terrible investment strategy.
There's no price appreciation. So how on earth are they making $770 million?
It comes from utility and interest. Think of it this way. Bitcoin right now is acting like a dot-com stock.
Like from the late 90s.
Exactly. It's volatile, it's speculative, driven by hype and headlines. But USDC is becoming the fiber optic cable.
Oh, I see.
It's the infrastructure. Circle's holding massive reserves of actual dollars in U.S. treasuries to back their coin. They earn interest on those reserves, plus they collect tiny transaction fees when people use the network.
So they are effectively becoming a very profitable digital-first bank.
That is exactly what they are doing.
I really love that analogy. So while everyone is betting on the flashy websites, the dot-com circle is just quietly selling the fiber optic cables that make the whole internet work.
They're selling the pipes, not the water. And we have a specific data point from the research that proves this isn't just theoretical.
Let's hear it.
The on-chain transaction volume for USDC in the fourth quarter hit 11.9 trillion.
Wait, pause there. 11.9 trillion.
With a T.
With a T. Up, 247%.
That is astronomical. I mean, that rivals the volume of major credit card networks like Visa or MasterCard.
It does. And that tells us something crucial about the economy right now. People aren't just holding these coins in a cold wallet hoping for a rainy day.
They are actually using them. Yes. They are paying for services, settling commercial debts, moving money across borders to pay suppliers.
We are moving from casino chips to digital checking accounts.
Exactly. And that explains why the traditional finance world, the suits, are suddenly paying very close attention.
Because I saw in the report that Circle actually received conditional approval for a national trust bank charter.
They did. And they are deepening their partnership with Visa. This is the big aha moment for the industry. While the crypto enthusiasts are staring at price charts all day, Circle is effectively merging with the real banking system.
They are becoming the digital dollar.
Precisely.
Okay, so the digital cash side of the family is winning. It's growing up, getting a job, wearing a suit to work.
Very responsible.
But then we have to look at the other side of the room. Digital gold. Bitcoin. Because while Circle is posting record revenue, Bitcoin seems to be having a bit of an identity crisis.
It is a stark contrast.
Right.
Early February was incredibly rough for the asset class.
Yeah, it was.
We saw a major risk-off shock. Basically, when investors got scared of the global economy, they sold everything that looked risky. And guess what they sold first?
Bitcoin.
Yep, Bitcoin. Based on the data, we saw $2.56 billion in liquidations in just a few days.
Ouch. That hurts. But I have to ask you, isn't the whole sales pitch for Bitcoin that it's digital gold?
That is the pitch.
That it's supposed to be a safe haven when the world gets scary? Like if the dollar gets shaky or the stock market wobbles, Bitcoin is supposed to be the thing that saves you.
It's what's printed on the brochure for sure. But the data says otherwise. Bitcoin right now is moving in perfect sync with the NASDAQ and risky tech stocks.
So it's not acting like gold at all.
Not at all. It's acting like a leveraged software stock. When interest rates or macro risks rise, Bitcoin dreams. It's highly correlated to risk, not a hedge against it.
And looking at this recent analysis from the firm Stifel, specifically from their strategist Barry Bannister, he's pretty bearish on it.
Very big.
He's talking about a potential drop down to $38,000, which seems incredibly aggressive given where we are today.
It is aggressive, but Bannister is a strategist who looks at market structure, not emotion. He points out two main failures in the bull case for Bitcoin right now.
Okay, let's break those down. What's the first one?
First, the inflation hedge argument failed. In 2025, the US dollar actually fell in value.
Right.
And Economics 101 says Bitcoin should have gone up as the dollar went down. But instead, Bitcoin fell too.
So the hedge didn't hedge. It's like buying fire insurance that refuses to pay out when your actual house burns down.
Exactly. If your umbrella leaks when it rains, it's not a very good umbrella.
Fair point. And the second failure?
Look at the ETFs, the exchange-traded funds that launched a while back. This was supposed to be the permanent Wall Street money that would stabilize the price forever.
Right. Everyone was so excited about the institutional money.
But according to the latest numbers, in the first 6 weeks of 2026, we saw $4.5 billion flow out of Bitcoin ETFs.
4.5 billion leaving the room. That's institutional money packing its bags and checking out of the hotel.
Fast.
But let me play devil's advocate here for a second. Just recently, we saw Bitcoin pop back up over 70,000.
We did.
Doesn't that prove the bears like Bannister are wrong?
It's a very fair question, and it's one a lot of retail investors are asking right now. But you have to look under the hood of that specific rally. That wasn't a flood of new investors believing in the future of the technology.
What was it then?
It was short squeeze.
Okay, let's walk through that mechanism. Because for the listener who doesn't day trade, what actually triggers a squeeze like that?
Think of it this way. Imagine a crowded room where everyone has bet money that the price of something will go down. That's what shorting is.
Okay, they're betting on failure.
Right. But suddenly, the price ticks up a little bit. Maybe it's just random noise or a single positive headline.
Right.
Those traders immediately start losing money on their negative bets. To stop the bleeding, they're forced to buy Bitcoin to close out their positions.
And their forced buying drives the price up even further.
Exactly, which then forces the next guy to buy to cover his loss, and the next, and the next. It's a cascade of forced buying.
So it's not enthusiasm at all. It's panic.
Total panic. It's like being in a crowded theater where someone yells fire, but instead of running out the doors, everyone is forced to run in toward the stage.
That is a terrifying image. But it makes perfect sense. So once that panic buying stops, The price is just tethered right back to those fundamental macro risks we talked about.
Right. And the biggest risk right now isn't just the price or interest rates, it's regulation.
Ah, yes. The Clarity Act. I feel like we've been talking about crypto legislation since I started hosting the show.
It feels like forever.
What is actually happening with this bill right now?
It's the ultimate will they, won't they drama of Congress. A few months ago, prediction markets pegged the chance of this act passing at about 80%.
Which is pretty confident.
Very. But now, it's dropped to around 50 to 60%. It's basically a coin flip at this point.
What is the holdup? Is it just standard partisan bickering in Washington?
It's actually much more technical and, frankly, more interesting than that. The main stickler right now is about stablecoin yields.
Which brings us right back to Circle and USDC.
Exactly. The big question Congress is fighting over is this. Can companies like Circle pay you interest for holding their digital dollars?
Why is that controversial, though? I mean, my bank pays me interest on my savings account.
Right.
Well, not much, but they pay me something.
Exactly. And the traditional banks absolutely hate the idea that Circle might be able to do it too, because Circle could potentially pay much higher rates.
Because they don't have all the overhead of physical bank branches.
Right. If a stablecoin can safely pay you 5% interest because they are digital and efficient, why would you keep your money in a traditional low-interest checking account at a big legacy bank?
You wouldn't. I'd move my money tomorrow.
Exactly. The banks view this as an existential threat to their deposit base. So they are lobbying incredibly hard to block that part of the legislation.
So the banks are just protecting their lunch.
Yep. And until that regulatory deadlock is resolved, the big institutional money stays on the sidelines. They hate uncertainty more than they love potential profits.
That makes sense. So to wrap up this first segment, if you want to sound smart at your next meeting, don't just say crypto is up or crypto is down.
Too basic.
Right. Say digital infrastructure like USDC is booming because of real-world utility, but asset prices like Bitcoin are struggling because of macro risks and regulatory deadlock.
That's the exact nuance that gets you invited back to dinner parties.
All right, let's pivot to our second story. And honestly, this feels just as strategic as the financial markets. We're heading to Washington, D.C.
Politics and money are usually two sides of the same coin anyway.
Very true. So President Trump, the State of the Union address, February 24th, 2026.
Just last night.
Right. He talked for a long time. He bragged about tariffs in general. He talked a lot about bringing jobs back to America. But he did something that hasn't happened in a State of the Union since 2005.
It really stood out.
He did not say the word China in an economic context at all.
It is remarkably disciplined, especially for him. Trump usually loves saying China.
He really does.
It's one of his signature moves, his absolute go-to applause line at rallies.
Right. So why the sudden silence? Is he feeling shy, or is he just ignoring the problem?
Neither. He's being highly strategic. It is entirely because of the calendar.
Okay, what do you mean?
We know now that Trump is scheduled to visit Beijing for a major summit with President Xi Jinping. That's from March 31st to April 2nd.
Ah, okay, so the trip is already booked.
The trip is booked. Think about it this way with a simple analogy. If you have a bitter dispute with your neighbor about a broken fence.
Which happens all the time.
Right. And you are scheduled to go over to their house for dinner next week to negotiate exactly who pays for the repair.
Okay.
Do you stand in your driveway screaming insults at them today?
Probably not. That would make for a very awkward dinner party. We'd probably save the tough talk for when you're actually sitting at the table.
Exactly. You keep it quiet. You leave room for a deal.
Yeah.
Trump is deliberately de-escalating the public rhetoric right now to maximize his leverage when he sits down across the table from Xi.
But does he actually have that much leverage left? This is where I want to bring in that Supreme Court ruling from the research.
Yes, this is key.
Because I remember seeing a headline recently about IEP authority, but I think most people, myself included, honestly kind of just glazed over it. Why does that matter so much here?
This is a crucial detail that a lot of general news outlets missed entirely, but the financial press is absolutely obsessed with it.
Okay, break it down for us.
The Supreme Court recently ruled against Trump's broad use of IEPA. That stands for the International Emergency Economic Powers Act.
So what is IEPA, simply put, for the beginner?
It was his big stick.
Okay.
It's an old emergency law that allows the president to regulate commerce after declaring a national emergency. Trump used it heavily in his first term to threaten 20% tariffs overnight.
Ah, I remember that.
He could just say, do what I want, or I hit you with massive tariffs tomorrow. And the key is, he didn't need Congress to approve it.
He could just bypass them completely.
Exactly. But now, the court effectively said no.
Wow.
They said you cannot use emergency powers for standard, everyday trade policy. They took the big stick away, or at least they made it much, much harder to swing without getting Congress involved.
So he's walking into this massive meeting with Xi, and his favorite weapon, the threat of unilateral overnight tariffs, is legally compromised.
Exactly. He can't just bully his way through legally as easily as he did before. That makes a negotiated deal his only real option.
Which completely explains the silence.
Right. He needs this summit to work because he can't just flip a switch and punish them anymore.
Okay, so if he can't just demand tariffs, what are they actually trading at this summit? What is on the shopping list for this deal package?
Based on the recent data and reports we're seeing, Trump has a very specific list. Number one on that list is critical minerals.
We're talking rare earths here, right?
Yeah.
The stuff that goes into our smartphones, electric vehicles, military tech.
Yes, all of that. The U.S. is desperately trying to build its own domestic supply chain for these materials, but right now, we are completely vulnerable.
We still need them.
We need China's minerals just to keep the lights on in our tech sector. Trump needs a guarantee that China won't suddenly cut off that supply as a retaliation tactic.
That's a pretty big ask. What else is on the table for him?
Fentanyl and farming.
Interesting comment.
These are strictly for his voter base. He needs a visual, highly public win on drug enforcement. So he wants China to crack down on the precursor chemicals that make fentanyl.
And the farming.
He needs China to commit to buying a lot more American soybeans.
The classic playbook. American farmers are his core supporters, and they need to sell those crops.
Exactly. Keep the base happy. And then, of course, there's Taiwan. But in this specific economic context, it's mostly about managing tensions.
Just keeping things calm.
Right. Preventing an accidental conflict in the Strait that would completely crash the global semiconductor market.
Okay, so we have semiconductors, rare earths, soybeans, and fentanyl. It's a very complicated trade negotiation.
Highly complex.
So if I'm an investor listening to this and I hear that Trump is being quiet and I know this Beijing meeting is coming up in April, what do I do? Do I just buy tech stocks assuming a deal happens?
No. You enter wait-and-see mode.
Okay.
The market hates uncertainty, but it does love a paused conflict. The specific sectors to watch right now are semiconductors and rare earths.
Why those two specifically over everything else?
Because they are the actual bargaining chips on the table. If the meeting goes well, we might see easier access to those rare earth minerals, which is great for tech, and maybe some relaxed export rules on semiconductors.
And if it goes badly,
then those supply chains get choked and those stocks will take a hit.
So it's definitely not a risk-on environment yet. We aren't jumping in with both feet.
No, it is purely risk management right now. Until that summit in April concludes, you have to expect volatility. Don't bet the farm on a handshake that hasn't even happened yet.
That is fantastic advice. You know, it's interesting how both of our topics today, the crypto split and the political silence, really just boil down to waiting for clarity.
They really do.
In crypto, we're waiting for Congress and the Clarity Act. And in politics, we're waiting for the Beijing summit.
That is the overarching theme of the quarter. The markets are just holding their breath.
So bringing it all together now, we promised the listeners they'd be the smartest person at the water cooler. How do we synthesize all of this?
I think the synthesis is discernment. Don't buy the general broad strokes story that the media is selling.
Right. So in crypto, remember, the market is splitting. You have the infrastructure play with USDC, solid revenue, real-world usage. It's basically the plumbing of the future financial system.
Exactly.
And then you have the speculative play with Bitcoin, which is struggling with interest rates, those massive ETF outflows, and a real identity crisis.
Correct. Don't paint the whole crypto industry with one brush. The pipes are valuable even if the water pressure fluctuates.
I love that. And in geopolitics, the silence is a strategy. Trump isn't ignoring China at all. He's just prepping for a very high-stakes poker game in Beijing.
Right, but because the Supreme Court took away some of his best chips, that IEPA tariff power, he has to play the hand differently.
Which means the outcome is far from guaranteed.
Exactly.
Well, before we wrap up today, I want to leave you, the listener, with a final provocative thought to chew on. Something that connects these dots in a way we haven't touched on yet.
I've actually been thinking a lot about this connection. We talked earlier about USDC becoming the digital dollar, right?
Right. It's becoming integrated into the standard U.S. banking system.
Exactly. So if the U.S. government effectively adopts a stablecoin like USDC as the standard for digital payments, does that actually give the government more power over crypto rather than less?
Oh, wow. That's incredibly ironic because crypto was originally supposed to be about total freedom from the state. That was the whole cyberpunk dream.
Exactly. But If the on-ramp and the off-ramp for all crypto trades are regulated, U.S. digital dollars, and the companies issuing them are banks with federal charters,
Then the government sees absolutely everything.
everything, it becomes the ultimate financial surveillance tool.
Yeah.
You end up trading your privacy for convenience and stability.
That is wild to think about. And connecting that directly to the China topic, if Trump's silence signals a shift away from a loud public trade war
Right?
and moves toward a quiet strategic resource war over minerals and tech, are we basically moving into an era where economic policy is just warfare by other means?
I think we are already there, honestly.
Yeah.
If money is purely digital and global trade is used as a weapon, the rules of the game have definitely changed.
That is a very heavy thought for a Wednesday, but a necessary one. If you want to survive this market, you have to look past the illusions. You have to know if it's a duck or a rabbit. Keep looking at the structural data, not just the flashy headlines.
Absolutely. Well, that is all the time we have for today's deep dive. We hope this cleared up the fog a little bit for you. Don't forget to subscribe and hit that like button. We'll see you next time on Investment Insight.